If you could see your entire financial life laid out on a single timeline, from your first paycheck to your final years, would you be proud of what you saw, or would you wish you could go back and shake your younger self by the shoulders? Here is the truth most Australians never hear. Every decade of your life has a hidden window, a short stretch of time where the right move can change everything, and the wrong move, or no move at all, can cost you hundreds of thousands of dollars. Today, I'm going to walk you through every age as an Australian investor, from your 20s to your 70s and beyond, so you know exactly where you stand and what your next move should be. Let's start in your 20s, because this is the decade almost everyone wastes. You're earning your first real money, maybe $60,000 or $75,000 a year, and you probably feel broke. But time is the single most powerful asset you will ever own, and right now you have more of it than any billionaire in this country. If you invest just $100 a week into a low-cost exchange-traded fund like the Vanguard Australian Shares Index Fund or the Vanguard International Shares Index Fund, and the market returns its long-term average of around 9% a year, you will have over $900,000 by the time you turn 60. Your job in your 20s isn't to pick the next big stock. It's to build the habit of spending less than you earn and investing every single month. Check your superannuation, too. The super guarantee in Australia is now at 12%, meaning more money is flowing into your fund than ever before. Switch from a high-fee default option to a low-fee growth option, and that 15-minute decision could net you an extra $200,000 at retirement. Finally, build an emergency fund of 3 to 6 months of expenses in a high-interest savings account earning around 5% to serve as a buffer. Moving into your 30s, life gets loud. The average first home buyer in Australia is now 34 years old, with the average new mortgage sitting at around $736,000. Many Australians stop investing here because every dollar gets swallowed by the mortgage. The smartest investors do something different. They keep contributing to their super, keep buying index funds on the side, and treat their home as a place to live rather than their entire retirement plan. This is also the decade to clear any high-interest credit card debt or personal loans, because no investment beats a 19% interest rate going the wrong way. As your income jumps with promotions or side hustles, avoid lifestyle creep by banking at least half of every raise straight into your investments before you ever have a chance to spend it. Welcome to your 40s. This is your peak earning decade, making it your most dangerous one due to full-volume lifestyle creep, bigger houses, nicer cars, and private school fees. The average super balance for Australians aged 40 to 44 is around $131,000 for men and $102,000 for women. If you are behind, don't panic, but do make a serious move on your super. The concessional contributions cap rises to $32,500 from July 1, 26, making salary sacrificing incredibly tax efficient. Outside of super, focus on a simple, diversified portfolio of Australian shares, international shares, and a small allocation to cash or bonds. In your 50s, retirement is on the horizon. To fund a comfortable retirement in Australia, you will likely need around $630,000 as a single or $690,000 as a couple, on top of the age pension. If you aren't there yet, your 50s are your last real chance to catch up using the carry-forward concessional contributions rules, which let you use unspent caps from previous years for a tax deduction. This is also the time to reduce risk slowly. You still need growth because retirement can last 30 years, but you cannot afford a 40% market crash 5 years before you stop working. Your 60s are the transition decade, with age pension eligibility kicking in at 67, though you can usually access your super tax-free from age 60 if you retire. The biggest mistake here is pulling everything out of shares and shifting it into cash out of fear. Cash loses to inflation every year, so you still need growth assets working in the background. Finally, your 70s and beyond are when your earlier decisions either reward you or remind you. You're either living comfortably off a growing portfolio or relying entirely on the age pension, which is a basic safety net rather than a comfortable life.
Your age isn't the problem. The only thing standing between you and the financial life you want is your next decision. Pick one small move today, make it consistently, and secure your future.